What's up, everybody? It's Brandon LeCaren here, and today we are talking about the 70% rule. So, what does the 70% rule mean? And it means that essentially you buy a property for 70% of the ARV minus construction costs. And I'm going to show you guys a breakdown of this today. But why is the 70% rule so important? So, it's an important rule when you're doing flips, when you're doing burrs, or for me personally, just buying any property, right? And the reason for it is, and you guys have heard me say this time after time, okay? It means that you make your money when you purchase the property rather than when you sell the property. So a lot of people prefer to make their money and they say, like, okay, I'm going to buy at market value and I'll make some more money when I sell the property. My philosophy on real estate is you need to buy properties that are undervalued and do what's called value add, because that way you make your most amount of profit. Not to mention you could get a slew of tax benefits when you're doing it this way, because you're adding value, you're creating more value in the property, as well as like larger cash out refinances. So this rule is super important when you're doing a burr or when you're doing a flip even, or like I said, just buying any real estate, for me at least. And it doesn't matter. It applies to commercial, it applies to multifamily, residential, condos, whatever, trailers, storage units, stuff like that. Especially now with us, going into this like sort of weird market. There's a lot of like people that are saying the market's gonna completely tank. I feel like for residential real estate, it's actually going to do the opposite. It's going to continue to go up. But that doesn't mean that there aren't any deals out there. There aren't any deals that are showing up. So you just need to talk to the right people to find those deals, and you guys will be successful. On the commercial side of things, I expect things to go down because office buildings have been unoccupied now for a few years, right, because of the pandemic. And you got to think of like, commercial real estate is like the slower moving tsunami, right? Whereas like residential real estate can kind of bounce back a little bit quicker, barring what happened in 2007, 2008. But commercial real estate right now, you should be buying, if you're buying it, you should be buying for essentially market 70% of the ARV, right, minus construction costs if there's any. You've heard of Manny Koshbin, who's made a ton of money in commercial real estate. I think his goal is to buy $1 billion in real estate over the next couple years, because he understands commercial real estate and he understands that there's gonna be a lot of deals. I've been talking to more of our investors every single day, and they're also interested in commercial real estate. Whether it's strip malls, gas stations, sort of like industrial places. So those are just some of the things that like of why people are buying commercial real estate right now, because of the huge upside in the next like year or 2 or 3 years, 4 years down the road. If you can hold out and maintain that building for that time period, I do think it's gonna come back, and it's gonna come back stronger, because a lot of zoning changes are taking place with these sort of like sell-offs, right? People are doing conversion from office to multifamily. So there's going to be a need for office, and especially in growing areas. I'm in the DMV here, and there's a ton of tech companies. Like you guys just heard, Amazon's moving here, Apple's here, Google's here. But it's not just those contracts, right? It's the people that support them as well. And people don't understand that, yes, it's cool, like if an Amazon moves to your town, it's great. But who else is there? Like you got to look at the who and not the what, right? The what is like, hey, like this is the Amazon effect, but who else is in the area? What other tech companies are there to support those companies? Because that's the key. That's where the bigger jump happens, in my opinion, rather than the Amazon jump. So let's jump into it. So 70% rule essentially states that you buy a property for ARV, and we're going to use simple numbers today. Let's just say the ARV of a property is 500,000, meaning that the market value of that property when you sell it, it's going to be 500,000. You're going to buy it for 70% of that. So you need to purchase that property for 350,000 minus construction costs. And what that allows you to do is, you build in your construction costs. You also build in any refinance costs. So let's jump to the whiteboard, and I'll show you guys that example of what it looks like, and we'll do it. So 70% rule. So the example here is a $500,000 property. So 500 ARV times 70%, right? So this equals $350,000. That gives us $350,000 to play with. So if you buy that property for $350,000, as you guys can see, you've already made a ton of money, right? You've already made essentially $150,000 in profit because you bought it for the low. You bought it for less than market value. You've protected your profit when you move into the property or when you buy the property. Remember, you do not make your money in real estate when you sell the property. You make it when you purchase the property. This is why it's important to understand the 70% rule. This rule could also be changed to an 80% rule. A lot of people do 80% rule because 70% rule is very aggressive. So it kind of just depends if you're in a C market, D market, A or B. A or B market, you're probably going to be closer to 80%. In a C and D, you're going to be closer to 70%. Now, if you do the 70% rule the right way, what will end up happening is you are going to essentially minus your construction costs, right? So minus construction costs. So what are some things in a property that you might end up doing, right? So you might end up doing a roof on this thing. So maybe, roof is about 10 grand, right? 10K. Maybe you do an HVAC system. That's also about $10,000. Maybe you do bathrooms and kitchen, right? So hope you guys can understand my chicken scratch, but essentially what you see here is we minus our construction costs. So right there, that's about $50,000, right, in work that we have to do. Well, let's say we got to do floors and painting, right? So we got floors, another 10 grand. So all that, as you can see, adds up to quite a significant amount of money, right? So we've got 10, 20, that's 50,000, 60,000, 65,000, $65,000 in repairs that you need to take off of this property. So it's going to be 350. So it's going to be 70% of the ARV minus construction costs. So then we're going to take 350 minus construction costs. So 65,000. So right there you can see that's about $285,000. So really and truly, you're buying this property for about, 60% almost of the ARV, and don't tell me these deals don't exist. They do exist, right? Because, there's people out there that are still buying these deals and finding these opportunities, especially where interest rates are at. So it's really important to understand that you have to be good at finding these deals. And one of the things I want you to pay attention of is I was good at underwriting this deal. I was good at understanding what construction costs are. So in order to underwrite these deals, you have to understand construction costs and what it's going to look like. Because if you cannot do that, then you're going to fail at this, and it's not going to be pretty because it's not awesome when your contractor comes to you and say, "Hey, I need another 20 grand or because of XYZ," and you didn't account for it, right? So you have to go through the property, walk it with your contractor, walk it with your people to understand what it would take. And, I've said this time and time again before, but, find a partner. Maybe you guys both got some cash and you both got good credit, but find somebody that's good at construction and maybe you're good at finding deals and you can partner, right? Because together you could do a lot more. You could do twice as many properties or even 3 times more properties because it's exponential. When you put 2 together, you're exponentially better, right? You're able to do way more than just double, right? So it's really cool when you have a good partnership. Plus, it's more fun doing it with a partner. That's why I love doing this is because I enjoy meeting people. I enjoy hanging out at a property with people. I was actually at a property this morning. with my best friend, and like, so it was a lot of fun. So it's really cool when you're able to do it with people that like, and trust, and you're able to just underwrite these deals together. You're able to put an offer, you have someone to celebrate with, and really go after it. So again, the 70% rule, I know, is very aggressive, but what it does though is it allows you, when you go do the cash out refinance, and you do a cash out refinance at 70% of the ARV, you actually keep, this would be your new loan amount, right? So you actually keep 30% of the profits in the property, 30% equity, not to mention now you're in this property for zero. And that's why the BRRRR strategy is really powerful when coupled with the 70% rule, or even 80% rule. Sometimes, again, like if you're looking in, sometimes A, B, and C, sometimes C area, you can get away with the 80% rule, but you have to like really know what you're doing. I recommend in a C and a D area, you do, 70% rule, and in a and B, I would say like 80% rule, because it's a higher growth market versus like a high cash flow market. So I hope this video was helpful to you guys. I hope you guys see the power of the 70% rule and why it's so important. Sorry about my voice. It's been like a rough couple of weeks here, but I'm feeling better, and God willing, I'll get better, much better soon. So thank you guys for watching. Hit the subscribe button below, like, follow, comment, and I'll see you on the next one. Peace out.